Welcome to the weekly wrap up. We are ending the week slightly higher, about an eighth a point higher than where we started. But we have been all over the board in between. So, Fed Chairman Powell talked on Wednesday. He did raise the federal funds rate. Guys, keep in mind, federal funds rate is what banks exchange money at. It also will ripple effect to car loans, home equity lines of credit, and credit cards. Mortgage priced in that adjustment probably 3 weeks ago and actually improved a little bit after his speech. He was very calm in his delivery. He was very soft in his tone, which really allowed the markets to have very little movement based on what he did, which was great. But then Thursday happens and we get jobless claims, which were the lowest since February. We get GDP, which was higher than expected. And then we get the nail in the coffin because our interest rates moved about 3/8 of a point yesterday. The nail in the coffin was bank regulators came out and said, hey, all banks are going to have to increase their capital reserve requirements. Well, when banks have to increase their capital reserve requirements, they have to sell mortgage-backed securities into the market to raise cash. When they sell those into the market, too much supply, not enough demand, interest rates go up. That's exactly what happened yesterday. And why the bank regulators had to say that yesterday after Powell was so calm and easing, I think it's suspect. But moving ahead to today, PCE came out, personal consumption expenditures. That is one of the best inflation reads. That came out slightly lower than expected. So all the movement that we got killed on yesterday, we recovered today. So here's what we know about this interest rate market. It is up and down, and that is what it is. You can't time it. Most importantly, we do know there are better days ahead. And there are going to be massive refinance opportunities and for people to capitalize on better interest rates in a year and a half probably. But right now, what we're talking about with every client is, does this monthly payment work for you? And down the road, how does that monthly payment feel for you? Can you deal with this monthly payment now? Or do we have to adjust your price point that you're looking at to accommodate your comfort level now? Or can we reallocate or be strategic in paying things off or adjusting debt now to accommodate that higher payment, knowing in a year or two, there are better payment days ahead? So that's the conversation. And at the end of the day, guys, we're not going to get that purchase price back because we know home prices are going to keep increasing. And especially if interest rates come down meaningfully, they are going to be pushed even farther. We can always adjust the interest rates down the road, but that sale price, it is what it is there. So that's the message that I'm giving to my clients every single day. And I hope you can deliver that message as well, or get them to us and we'll deliver it. So if there's anything else we can be doing for you, let us know.